Hi guys, your friend Gopika is here, and in this video we'll be discussing some features of GST and few basics of shares and some basic definitions of several terms under shares. Okay, so this topic is not there, or it has been removed for the 2020-2021 batch, but for the other batches or for the future batch students this topic is there. But this, due to COVID-19, 25% syllabus was reduced for the 2020-2021 batch. For them this topic is not there. For the syllabus details, you can check out the videos on syllabus reduction in our channel itself. I'll provide the link in the description box. And the students who are interested to learn extra topics which has been left for self-study can watch these videos. So without wasting time, let's get started. Okay, first we will discuss few features of GST. This is for extra information, but we will just breeze through the points. First thing is, many indirect taxes are subsumed under GST. Okay, many indirect taxes are now included under GST. Those taxes, the names or the different types of them have been removed, and all of those are included under GST itself. And there is no dispute between goods and services. For goods and services, the tax, since goods and service tax, the GST covers both the type of taxes. There is no dispute between goods and services. Okay, next, state-wise registration for traders. Now under GST we have already learned that the trader has to register himself under one state where his business belongs. Okay, so there is state-wise registration for them. Next, the GST IN holder, that is GST identification number holder, needs to keep all the records and should pay GST in time. So all come under the tax system naturally, because since they are registered, every transaction that takes place has to be recorded, and every person or everyone with all the person with a business firm or a business holder, they are supposed to pay GST on time also. So there is transparency. So the next comes the transparency in transactions. So there is no black money or that sort of transactions happening. Everything is under record and under the supervision of the government. So there is transparency in that transactions. Now this tax system is simple and easy to understand. Now in the beginning of the chapter itself we learned that many types of taxes, in before for different types of goods and different types of services there were different taxes and they had different names. But now, since they came under common name GST, the tax system has become very simple and easy to understand. Under GST there are several rates fixed for different types of products and services, and then accordingly half the tax goes to the government and half goes to central government, half goes to state government, whatever, all those things are done. There is no certain different names or different rules. The rules and the name of the tax is same, only rates are different. Okay, so the tax system has become much more simpler and easier to understand. Next, removal of cascading effect of tax, hence the prices are controlled. So before, when there were different taxes, different types of taxes for different products or different services, under the increase or decrease of taxes, the prices of the products or the services are also were affected heavily. And when the tax is increased, the shopkeeper or the person or whatever, the business holder could take high prices in that name. All this stuff happened before, but now since full country is under one tax system, and for a particular product throughout the India the tax will be same. It's not like in Maharashtra that product has different tax, in Kerala it will different tax. It's not like that. Throughout the states or throughout the country, a fixed product or a fixed type of product has fixed rate of tax. Okay, so these types of manipulation in prices of the products won't happen. Then increase in quality of goods and services as they are globally competitive. So the quality of goods and services also increased, and there is boost to Make in India project, because whatever the things which are manufactured in India, those things got boost in the market. Then technology driven tax system leads to speedy decisions. So when the tax system is technology driven, now in GST we learned that every business holder has to register himself in the GST portal, which is online registration. Okay, so once he is in the system, and when the system is online or technology based, everything happens in a greater speed. Before there were paperwork or all those things, the work happened in its pace. Now when it is technology driven, everything will be faster. The penalties of late payments or whatever, everything will happen faster than before. Next, goods and service tax system is a dual model, as equal amount of taxes levied by central and state governments. So, system, both the tax, central government and state government, both their taxes are covered under GST. Throughout the India, it is same system, and throughout the India, a fixed product has fixed rate of tax. So, in many ways, and there is no different names for different products or different service taxes. Everything came under this goods and service tax, that is GST, which makes the system simpler, easier, faster, and boosting the products which is manufactured in India itself. Okay, so these are the features of GST. Next, the types of taxes under GST. Now, under for state, we know that there is state GST. For central government, it is central GST. Then there is UT GST, that means in the Union Territory GST. So these are the, now one branch, there are three types depending on the government. Now if central government is collecting the amount, then it is central GST. State government collects state GST, and Union Territory government collects the Union Territory GST. Okay, depending on the state or Union Territory where the firm or the business company is registered, accordingly they will have to pay UT GST. If it is registered in a Union Territory, then they pay UT GST. If it is registered in a state, then they have to pay state GST. Okay, central GST is common to everybody, because anywhere you are running a business, part of the tax certainly goes to central government. Okay, and a part of it goes to the state which the business firm belongs, or to the Union Territory which the business firm belongs. Next, composition scheme, that is CGST plus SGST. This also we already learned. Together, half the amount goes to central government and half the amount goes to state government. And next comes the interstate GST. Now, other types of GST were paid when the transaction is happening within one state. So, for example, if within Maharashtra, a business firm in Pune and a business firm in Mumbai, if they happen to trade, and if there is a transaction happening, then the amount of tax is calculated, and half will go to central government, half will go to state government, all those things happen. But from Maharashtra, if the product is sent, or if the transaction happens between two business firms, one in Maharashtra and one in Rajasthan, that means two different states, that is interstate transaction happens, suppose, then there is IGST, that is interstate GST. Okay, so the first is SGST, CGST or UT GST, tax levied for trading within state. When it is within state, there is a fixed rate of tax, and in that, suppose 18% GST is there, then 9% will go to CGST and 9% goes to SGST. This we already know. Next comes the composition scheme. For those GSTN holders whose annual turnover is between 20 lakhs to 1.5 crore, they pay CGST and SGST with special rates. Okay, so for the GSTN holders whose turnover is more than 20 lakhs and it's up to 1.5 crore, then the rates are different for them. Okay, beyond a limit, if their income is, or if their turnover is beyond a limit, then the rates of taxes also accordingly change. There are special rates for them. Okay, and the third thing is the IGST, which I already told, tax levied by central government. If there is interstate trading, that is, if the trade happens between two different states, between Maharashtra and Gujarat, or Maharashtra and Rajasthan, or Maharashtra and Kerala. Okay, if it happens, then interstate GST is levied, and it is levied by the central government. Okay, so these are the different types of taxes under GST. Okay, now we start with the actual topic which you are supposed to learn from this chapter, that is shares. as I said already, for the 2020-2021 batch students, that is SSC students, this topic is removed. Okay, due to COVID-19, you already know that 25% of your syllabus is removed. So this topic is left for self-study for your people. That means it won't be asked in the exam. But the interested students can follow our videos if you want to learn the topics which is left for self-study. Also for the future batches, this will be helpful. And if you are confused about the syllabus reduction, then please refer to our videos. I'll provide the link in the description box wherein we are showing what all things are removed for you this year with textbook markings. Okay, so for that please check the description box. So let's start with the self-study. First self-study topic in financial planning, that is shares. Okay, so few terms we will have to learn. Now this is an introduction. After that we'll learn few definitions. To own a shop is proprietorship. Okay, so if you own a business or if you own a shop, you can call himself as a proprietor. Now when two or more individuals come together to carry out a business, it's a partnership. Okay, at times to start a business, 2 or 3 people come together because one person might not have enough fund or enough sources to start a business. So 2 or 3 people might come together and they can start a business in partnership. Okay, they are called as partners in the business. Now which requires small capital. Capital means the amount of money which is required to start a business. Now company is to be registered under the Indian Companies Act 1956. Now this is for general knowledge. Okay, under Indian Companies Act 1956 the company has to be registered, and then the person who form a company are called promoters, and the company itself is called limited company. When limited number of people come together to start a business, you can call it as a limited company. And the person who forms all the people who forms the company are called as promoters. Okay, next, amount required to start a company is called capital. Now this capital is divided into small equal parts, and this small part is called the share of the company. Okay, when you start a company, you require a sum of money, or that money is called as capital. Now this capital is divided into small equal parts, just like parts of rupees 100 or rupees 1000 or rupees 2000, like that. In small equal parts it will be divided, and this small parts is called share of the company, and these shares are sold in the share market to raise the capital. Okay, so what happens, the people according to their thinking capability or whatever, they will decide if this company is profitable, or if it has a high scope or not, or how much money should be invested under this. Okay, the people who buy shares or who are well versed in share market, what they do is they can make out how the market works, and then they buy the shares or shares of different companies, and then when the company is in profitable position, they will sell their shares to earn money. Okay, this is what happens. Now, so in the beginning of the company, what happens, these shares are sold in the share market to raise the capital. So different people from different parts of the world, different people will collect or will buy the shares. Okay, and accordingly the amount will be generated to start the business. Okay, so that's how the amount is raised. Next, Now that's all with the definitions. Now few extra points we need to note. Okay, first thing is, in the live share market, the market value changes frequently. Okay, in the live share market, what happens is the market value of the shares will change frequently, within days or within minutes, just according to the performance of the company and as a whole the economical system of the country or of the state, whatever. These things are going to change very frequently. And if the company's performance is better than expected, then those shares are in demand. Okay, the company which is performing well, obviously their shares are going to be in demand, and the number of shares is fixed, therefore share supply could not be increased, and hence the share price increases. Okay, now the number of shares is always fixed, and therefore the share supply will not increase. Okay, only the price of each share will increase. Number of shares cannot be increased. Okay, now if the total capital is fixed, then obviously the number of shares are also fixed. So only thing what will happen is the price of each share will increase, and if the company is not doing well, the share price will obviously fall. Now increase in price is shown by green triangle upward. Okay, green triangle upward means there is increase in price of the share of that company, and decrease in price is shown by red triangle downward. Okay, so these are the symbols used in Sensex to show if the price is increased or decreased, okay, of shares of a particular company. Now next, this is the reason for increase or decrease in Sensex and Nifty index. Okay, so depending on the company's performance, the prices will fall or prices will rise, and that is why there is increase or decrease in Sensex or Nifty index also. Okay, next, the final point is, whatever may be the market value, the dividend is always reckoned on the face value of a share. Okay, the dividend which the shareholder receives from the company, dividend means the part of annual profit that is given to the shareholder according to the proportion of share that they hold, that amount is dividend. Now that dividend is depending on the face value of the share, that is the value which is written on the certificate, on the share certificate, not on the market value of that company. Okay, so if you are holding 20% of the share, then you are going to get 20% of the profit only. Doesn't matter if the market value is higher or lower, depending on the share value, that is depending on the face value of the share, you are going to get the dividend. Okay, that is the part of the annual profit of that company. So these are the few extra points other than the definitions. So that's all for the video. In the next video we will discuss further details about market value and face value, all that stuff. So if you like the video, please share it with your friends and please subscribe the channel. You can also follow us on Instagram, and do write in the comment section for your doubts and suggestions. Okay, thank you.